The next topic is about the unconventional monetary policies. And for the unconventional monetary policies is the tools that the central banks also around the world, especially the large central banks such as the Federal Reserve, the ECB, and the Bank of Japan, and the Bank of England too. Also of the central banks in the developed countries try to embrace the unconventional monetary policies. Here are the examples of the unconventional monetary policies. Liquidity provision, large-scale asset purchase. I think you guys may be a little bit familiar with this term, large-scale asset purchase. That is the central bank try to buy the asset that has the troubles. Okay, it is like a bailout. Okay, to increase the liquidity in the balance sheet of the commercial bank. The next one is a quantitative easing or QE. Okay, QE. And the credit easing, quantitative easing and credit easing. And the last one is the forward guidance. What is the forward guidance? Forward guidance is a type of the central bank communication that the central bank try to anchor the inflation expectation of the general public. Okay, let's see for this one. I will focus on the forward guidance because it is easy to me. I can talk about it because I just did the research for this one. And you can see for this graph, we have two types of the graph. The first one is the line graph here, and the next one is the bar chart. For this one, and for the red line here, it is the Fed fund rate. Okay, the Fed fund rate or the key policy rate that we just studied in the market for research. And here the bar chart represent the paragraph, the number of the paragraph in the central bank press release. In this case, is the Federal Reserve. When the Federal Reserve holds the monetary policy committee, when they finish the meeting, they just release the document to the press, and this is the numbers of the paragraphs in that document. And you can see that the numbers of the paragraphs in the Fed press release hit the new high, especially in the 2014. And after that, here, the number of the paragraph decreased. For this one, we have the tapering out. I think for this one, it means that the Fed try to taper everything out and then finish the unconventional monetary policy. So it's marked the red line, the red chart here, the red graph here. Okay. So for this one, you can see that when the interest rate goes down after 2008, the interest rate or the Fed fund rate just lie in these regions, which is nearly zero, and it cannot go negative. We call this situation the zero lower bound. Okay, the zero lower bound. It is the constraint that imposed on the interest rate that the key policy rate cannot go below zero. So when the interest rate cannot go below zero, what happens? The monetary policy is useless. Okay, the conventional monetary policy is useless. Okay, because the interest rate cannot go any further after this. As a result of this, the central banks has to turn to the central bank communication. That is, the central bank trying to talk more to the public, to the general public. You can see that in the 90s here, the central bank tend to be secretive, okay, secretive organization. It hardly talk to the general public. But for this one, after the crisis, the central bank talks a lot to the public. Okay, this is to anchor the expected inflation of the general public. Okay, here is the numbers of the paragraph. You can see that we have very high numbers of the paragraph here, especially in 2014. Central bank talks about. And this is the sample message from the central bank press release in the case of the US. And to summarize, it as the word cloud, you can see that I would like to draw your attention to this one. The central bank tend to focus the communications on the inflation rate, because the word inflation is a very high frequency word in the press release. That's why it can be somehow show that the central bank try to talk about the inflation rate. The next one is the economic condition. They then talk about the Federal Reserve, and they talk about the Fed fund rate. I think this word should be the same word, but in my research, I don't concatenate this word together. That's why it's just separate into two different words. So this one should be the interest rate. So the word that the central bank uses a lot, especially in the case of the US, is the inflation and the interest rate. Okay, inflation and the interest rate. Because the central bank try to anchor or try to control the expected inflation. Okay, the expected inflation. Why expected inflation is so important? Any ideas on this one? Why the central bank care about the expected inflation? Why? Any idea, please? Delicious. Any idea about this one? Why the central banks cares about the expected inflation? Money supply. Thank you. Thank you for your answer. Okay, let's see this one. Have you? I'm not sure whether you know this term. Have you ever heard about the Fisher equation? The Fisher equation. Okay, now let's see. I will show you that why the central bank try to talk about the inflation and try to control the expected inflation. Okay, let's see. I will use the Fisher equation to explain. Oops. From your macroeconomics 101, this is the nominal interest rate. Okay, I will skip the T here. I will use only the variable. This is the nominal interest rate. It's equal to the real interest rate. Okay, plus the expected inflation. This guy is the real interest rate, and it is the rate that will affect the real economic activities. In fact, it will affect the level of the private investment. It is the cost of borrowing of the private firms. Okay, you can think of it like this one. Okay, what will happen? Suppose that this guy is the nominal interest rate. The central banks can employ the monetary policy tools to determine the directions of this variable. It can employ the open market purchase, or it can employ the open market sales. Okay, so for the open market purchase, for this one, what will happen with the interest rate? It will go up or down. When the central bank conduct the open market purchase, the key policy rate will go up or go down. Purchase. Goes up or down? Interest rate. Go down, correct. For the open market purchase, the central bank can control the direction of this nominal interest rate. So you can think of it as an interest rate that will change according to the key policy rate. What next? As you know that here the real interest rate will affect the level of the investment, right? So ideally, it should be when I decrease, I should decrease, and so investments goes up, and then we have higher demand, and we have higher output in the short run. this should be the relationship that we can expect. However, in reality, we have this guy. This guy is the expected inflation. Expected inflation. Suppose that the central bank can lower the level of the nominal interest rate, and people expect the lower inflation in the future, pi e will decrease. Suppose that pi e decrease at the same magnitude with the same at the same magnitude of the nominal interest rate. What will happen? Unchanged. The real interest rate unchanged. Okay. Okay. Now, when the interest rate goes up, what happens next? Suppose that the people or the general public expect that we will have the higher inflation in the future. This guy will go up, and it will absorb the effects of this one into itself, right? So it will leave the real interest rate unchanged, or the real interest rate remain the same. Okay, the real interest rate will remain the same. That is why we need to anchor the expected inflation. Otherwise, the monetary policy will be not perfect. Otherwise, the monetary policy will not produce the perfect or the nearly perfect effects on the real interest rate. So what happens if we can anchor the expected inflation? It means that we try to hold this guy constant. Okay? When the I here goes up, the R here also goes up. When the I here goes down, the real interest rate here also goes down. So this guy will affect the investment. Okay? If we can anchor the expected inflation, that is why the central bank try to communicate or try to talk to the public about their policies, because the central bank would like to form the expected inflation of the public. If the central bank can influence the expectations, the monetary policy will be more effective than the case that the central bank cannot influence the expectation. So this is the heart of the monetary policy. What is the monetary policy? The monetary policy is also about the expectation management. This is the heart of the monetary policy. The expectation management. That's why we will see that is why we see from our slide that the central bank try to communicate more with the general public, because the central bank would like to anchor or try to make these expected inflations constant. If it can make these guys constant, it can use the conventional monetary policies, and it will influence these guys, which is the real interest rate. Okay. That is also about the central bank communication. This equation is called the Fisher equation. The Fisher equation. It will be in your macroeconomics, I think 101 or something. I'm not sure about it. Okay, let's see. Okay, I will get back to my slide. This is the very current topic that the monetary policies, the policymakers try to study the central bank communication. If you would like to read further about this one, you can go to the Google and then you just type my name. Google. I'm not sure whether you know my name or not, but my name is here. SAPPHASA. Okay. Where it is one? Let's see. Okay, you can go to this one. idea, the last one, and then click it, and you will find that here. Word matter, effect of semantic similarity. And when you click it once, I'm not sure that you can download it or not. Okay, this one. This is the paper that you can read if you feel interested into the central bank communication. But for this one, I just extend my paper into to cover the case of Thailand. Okay. Okay. Now, I think I will talk about the market for foreign exchange rate, and then I will let you go. I will use 30 minutes for this one, 30 minutes for the next topic. Okay, let's see. This is the last topic. It is the market for the foreign currencies or the FX market. Okay, the FX market. Okay, I will be brief about these topics because I know that you guys would like to prepare for the presentation. Okay, let's see. In these topics, I will emphasize only this guy, okay, the foreign exchange market. I will leave the financial crisis for you guys to teach your friends, okay. Your presentation will be the topic that I think you should study from your friends because it is like the last lecture. Instead of me talking in front of the class, I will let you guys to teach your friend, okay. So don't think of that presentation as the task, but think of it as the lecture that you can give to your friend. Oh, this is very dirty. Okay, so I just see the salesman of this one. Okay, the long run and the short run determinants of exchange rate. Okay, let's see the first one, the long run determinant. I think you guys are familiar with the exchange rate. Okay, let's see what is it. Exchange rate is the price of one currency. The price of one currency in terms of another currencies. For this one, suppose that we have the reference rate as the USD. The price of one USD equal to 40 baht. So you will have to use 40 baht to buy one USD in the foreign exchange market. Okay, in the foreign exchange market. When Thai baht becomes more value, we will call it Thai baht appreciate. Okay, Thai baht appreciate against the dollar. And for this one, when the Thai baht value, when the value of the Thai baht falls, we will call it the Thai baht depreciate against the US dollar. So this will be very important, especially when you borrow the money from other countries. Suppose that you borrow the money and the money is quoted in the terms of the USD. Before 1997, we had 25 baht for $1. But after the 1997, we have 70 to 50 baht. Okay, 70 to 50 baht for $1. Okay, for $1. So if you borrow 100 USD from other countries, and before the 1997s, you will have to pay with 2,000 and 2,500 or something. Okay, for the debt in the USD. But after the 1997, you will have to pay 5,000. Okay, 5,000 baht. So you will see that the debt burden increased a lot. If your domestic currency depreciate against the foreign currency, that's why this is really crucial. And we can use the derivatives. Okay, we can use the derivatives to hedge against the fluctuation in the foreign exchange rate. And we will group the exchange rate into the spot and forward, spot here and forward here according to the transaction. For the transaction that occurs today, we use the spot rate. And for the transaction that will occur in the future, we use the forward rate. Okay, so we have the spot exchange rate and forward exchange rate. What time now? This guy. I will skip this slide. I will talk only the topic that I feel really crucial for you guys to know. So this one you can read by yourselves. Okay, let's see. This guy is very important. The factors that determine the movements of the exchange rate in the long run. Okay, in the long run, the factor that determine the movement of the exchange rate is the purchasing power parity or PPP. PPP is based on the law of one price. When we have two identical goods in different countries, suppose we have this pen in Thailand and this pen in the US. Suppose that the price of this pen in Thailand is, let's say, 40 baht, okay, 40 baht, and the price of this pen in the US is 1 USD. The exchange rate implied by the PPP should be 40 baht for 1 USD. And when the exchange rate in the market deviate from this rate, it will be the arbitrage opportunity. Okay, the arbitrage opportunity to reap the profit, to reap the unexploited profit from the deviations of the rate in the market and the long run rate, which implied by the PPP. Here is the arbitrage mechanisms. Suppose that here is the rate implied by the PPP, and this is the hypothetical example, so this may be a little bit different from the real world. This guy is the rate in the market. It is the 80 baht for 1 USD, okay, per 1 USD. You will see that we will have the arbitrage mechanism here because the rate here in the market is different from the rate implied by the PPP. The rate here is the rate in the long run. The equilibrium in the long run should be 40 baht per 1 USD. But this one is from the market. So what will happen? The arbitrageurs can buy a pencil in Thailand with 40 baht. We start with 40 baht, and then we can sell that pencils in the US, and we earn 1 USD. And we can go to the foreign exchange market, and we just exchange 1 USD for 80 baht. So we will earn the unexploited profit equal to 40 baht here. Because this one is the price that we can sell in the FX market, which is 80 baht, right? And we start from this point, which is 40 baht. So 80 minus 40 is 40 baht. 40 baht is the unexploited profit that the arbitrageurs can reap from this transaction. So, as a result of this, it will increase the demand for baht. Okay, it will increase the demand for baht because people just sell the USD in the FX market. There will be the excess supply. There will be the excess supply of USD in the FX market, and there will be the excess demand for Thai baht in the FX market. As a result of this, Thai baht will appreciate against USD, against the USD. As a result of this, we have higher demand for Thai baht, and the Thai baht will goes up, the value of Thai baht goes up, and the value of the USD goes down. When we say goes up, I mean the appreciation. When we say go down, or when I say go down, I mean the depreciation. Okay, the depreciation. So in the long run, the interest, sorry, not interest rate. In the long run, the exchange rate will be determined by the purchasing power parity or PPP. PPP will give you the rate in the long run, that the equilibrium rate that the market should evolve to that point. Okay, and you can write it down in the forms of the equation. On your right hand side here is the exchange rate equal the price. The price here is the domestic price over P star. P star is the foreign, or for P is the domestic price. P star is the foreign price. Okay, foreign price. When you flip the equation, P star will be multiplied by E. It will be set equal to the domestic price here. So this is the relationship of the purchasing power parities. Okay. One thing you have to make sure that you understand for this part is that you have to make sure that you understand the arbitrage mechanism. The arbitrage mechanism. Okay, that is also about the long run of the exchange rate. Okay. Okay, this one I think I will talk a little bit about this, the real exchange rate. For this one, when we try to compare the competitiveness of the countries, okay, when we try to compare the competitiveness of the countries, we can use the real exchange rate, okay, the real exchange rate to compare the competitiveness of the countries. And this one's in the examples, okay, this one is the example. In fact, we try to convert everything into the real term, okay, into the real terms, and then we compare each others, okay. So exchange rate can be used to measure the competitiveness of the country. The cheaper, the better, okay. The cheaper, the better. The cheaper, the better. In terms of the real exchange rate. Okay. I think I talked about the factor that determine the long run exchange rate already. And next, I will move to the factors that determines the exchange rate in the short run. Okay, in the short run. Okay, let's see. I will move to the next one here. Okay. Oops, sorry. Let's see for this one. I'm sorry, we are still in the long run. Sorry. This is still in the long run. Okay, the next. In addition to the PPP, we also have the relative price level. The relative price level. This is the factor that also determines the movement of the exchange rate. You will see that in the long run, a rise in a country price level. Okay, a rise in a country price level. You can think of it as the domestic price level. A rise in the domestic price levels compared with the foreign price level will cause the currency in that country depreciate. Why? Because the goods and services in that country will be more expensive, compared to other countries, and this will somehow lower the demand for domestic goods and services. That's why that currencies will depreciate against the foreign currencies. Next one, the trade barriers. Here we mean tariffs, which is a tax on the imported goods, quotas, restrictions on the quantities of foreign goods. For this one, you can think of the trade war, which is the trade war. Suppose that our countries impose the trade barriers, okay? It will increase the demand for the goods and services of our countries. This will somehow lead to the appreciation of the domestic currency, okay? The depreciation of the domestic currency against the foreign currencies. You can think of the relative price levels and the trade barriers as the factors that determine the demand for goods and services. If it increases the demand for goods and services, it will also increase the demand for that currency too. For this one, when we have higher demand for goods and services, domestic goods and services, it will also increase the demand for the domestic currency. As a result of this, the home currencies or the domestic currency will appreciate against the foreign. Okay, so far so good. So far so good. Next, preference toward domestic and foreign. This one is pretty straightforward because if we have the preference toward our domestic goods and services, it will somehow increase the demand for the domestic currencies. And this will lead to the appreciation of the domestic currency against the foreign. And the last one is the productivity. Okay, the productivity. The country with very high productivity, the country with very high productivities will have the higher value of the domestic currency too. Why? Because higher productivity means cheaper cost of producing goods and services, right? So this will somehow lead to the higher demand for goods and services in that country. So this will cause the domestic currencies appreciate, or the currencies of that country appreciate against another country. Before I go to the short-term factors that determine the movement of the interest rate, can I ask you some question? What is productivity? What is productivity? Can you give me say plain English for this one? What is productivity, please? What is productivity? Higher productivity, good or bad? Good, right? Why good? Why is good? How can we measure productivity?
Like for example, like in our country, we can measure our productivity by the rice and how much we produce by each year.
Okay, thank you. Thank you very much. Very good question. Sorry, very good answer. Very good answer. Very good answer. Sorry, I just confused. Very good answers. And for this one, you can compare the amount of goods and services between two countries. Your friend just used rice. Okay, you can compare the amount of rice in Thailand and Vietnam. You may hire a person from Thailand, a person from Vietnam to produce rice within 1 hour or 1 year, and then you compare the amount of rice, okay, that you will obtain from that two workers. If a person from Thailand can produce more rice compared to a person from Vietnam, it means that we have high productivity. Okay, very productive. Very productive. Okay, higher productivity will lead to the appreciation in the domestic currency. Okay, in the domestic currency. Sorry, I'm just a little bit confused. Okay, the next one is the short run determinants of the exchange rate movement. For this one, we mean the interest rate. Okay, the interest rate is like a magnet that involves the flows of the foreign funds. Why? You can see from this. Let me see. I think if I go to the graph, it will be a little bit confused for you. Okay, let's see for this one. Okay, the factor that determines the short-run movements of the exchange rate is the interest rate. By interest rate here, I mean the interest rates on your bank deposit, the interest rates on bond. Okay, and why we have equity here? Because the interest rate here means the rate of return. The rate of return of the financial asset. Okay, the rate of return of the financial asset. You can think of the interest rates as the rate of return of the financial asset. Okay, or the returns on the asset. Okay, let's think about the logic first and graph later. Let's think about the logic. If you got the logic, it would be okay. You don't need to understand graph because graph is just the representation of the logic. Let's see for this one. Suppose that we have this guy is the interest rate for the domestic country, and this is the interest rate from the foreign country. When we have the domestic interest rate greater than the foreign interest rate, what will happen? Suppose that we have only two countries in the world, only two countries in the world. this side is Thailand, this side is the US. Okay, suppose that we have the domestic interest rate here greater than the foreign interest rate. It will cause the capital inflow. The capital inflow. Okay. Investors will have higher demand for Thai baht because they would like to use the Thai baht to invest or to deposit in the banks, in the domestic bank. Okay, in the domestic bank here. So this will somehow lead to the appreciation in Thai baht and the depreciation in the USD. On the contrary, if the interest rate in the foreign countries greater than the interest rates in the domestic country, this will cause the capital outflow. We are here because we guys are in Thailand. So this will cause the capital outflow. And when it's caused the capital outflow, it will cause the depreciation in Thai baht because investor will throw the Thai baht out and try to chase for the USD. Thus, as a result of this, the USD here will appreciate against Thai baht. So you can see that the interest rate here for the financial asset is the factor that determines the movement of the exchange rate. You can think of it as the investment in the portfolio. Okay, in the portfolio, and these guys are return. Okay, these guys are return. For the red line here is the capital inflows, and for the blue line here is the capital outflow. Okay, now let's get back to our slides, and now I will translate our logic into the graph. Oops. Okay. Okay. This is the market, another market, which is different from our market for reason. For this market, the goods and services here, in this market are the currency, foreign and home currency. We will have the vertical axis here as the price, of the home currency, or we quote the home currency in terms of the foreign currencies. Okay, and here for these graphs on the horizontal axis, this one we will take this graph into our considerations when we are Thai, okay, because we now are Thai. But for this one, from the Thai perspective, okay, from the Thai perspective, from the people in Thailand. So the quantity here will be Thai baht. But if you consider this graph from the foreigner's perspective, this guy here, foreign, should be Thai baht, and this should be the USD, and this will be the USD. Okay, so let's make it clear that when we switch the country, we may need to change the verticals and change the unit of the horizontal axis. For this one, the supply of Thai baht is fixed. This one is here. It is my assumption that the exchange rate here will not affect the supplies of the Thai baht in the FX market. And this is the demand. Okay, this is the demand. I think I will leave this equation because it will complicate our understandings of the graph. But this one is the demand. Okay, the demand for Thai baht. Now our home currency is Thai baht, and the foreign currency is USD. Again, home here is a Thai baht. Foreign is a USD. And the horizontal axis here is Thai baht. Okay. So you can see that this graph, this vertical axis represent the price of the Thai baht, okay, in terms of the foreign currency. If the price of Thai baht goes down, we will have the higher demand for Thai baht. If the price of Thai baht goes up, we will have the lower demand of Thai baht. Okay? You should think of Thai baht as a product, and that product will be quoted in USD. Okay, will be quoted in the USD. So we will have the negative slope demand curve. It is pretty straightforward for the demand and supply. And here we will have the equilibrium at the E star. E star is the equilibrium exchange rate for the short run. Okay, for the short run, E star is the equilibrium exchange rate. Remember that this guy is Thai baht. This guy is the USD. Okay, what happened next? This is the logic that I just explained in the in my writing here. Okay, this is the logic that I just explained in my writing here. So let's see what will happen. And suppose that we have the higher domestic interest rate. Suppose that we have the higher domestic interest rate compared with the foreign interest rate. It will cause the capital inflow. It will cause the capital inflows. The capital inflows lead to the higher demand for Thai baht, which is our domestic currency. Ceteris paribus, or keeping other factors constant, we will have the demand curve shift to your right hand side, and the exchange rate will go up. It means that Thai baht appreciates against USD. Capital inflow cause the appreciation in Thai baht against the USD. Okay? Okay, what next? Okay, for this one. Alternatively, suppose that we have the higher foreign interest rate compared to the domestic interest rate. This will lead to the capital outflow. This will lead to the capital outflow. The investor try to chase return in other countries. So the investors will sell Thai baht in the market for the foreign exchange rate. But for this one, keep other factors constant. You can think of this as it will lower the demand. Okay, it will lower the demand for Thai baht because people try to switch from Thai baht to other currencies or other foreign currencies. This will lower the exchange rate from E1 star to E2 star because we have the lower demand for Thai baht. It will shift the graph to the left hand side. In fact, it can. Okay, in this course, I will emphasize only the factors that determine the movements of the demand here, and it will cause the fluctuations in the foreign exchange rate. But if you study the topics of the foreign exchange rate deeper, you can see that we also have the factor that determine the supply of the foreign currency too, of the supply of the Thai baht in the foreign exchange market too. But in this course, I think I would narrow it down to the change in the demand. It would be sufficient for this course. Now let's see the empirical facts for Thailand. You see that from the textbook. In the textbook, we told you that the differentials of the interest rate will cause the capital inflow and capital outflow, right? And it will result in the appreciation or depreciation in the domestic currencies. But in reality, you will find that the factor that is the most crucial, that's very crucial in determining the movement of the exchange rate is the sentiment, the market sentiment, because it accounts for the movements here at 80% or something. But for the interest rate, here, the interest rate differentials, it will be 1, 2, 3, 4, 5. Factor number 5 here, interest rate differential, it accounts only 3% for Thailand. So the most important factors is the sentiment. It is the market sentiment for this one, or sentiments of the whole financial market. Okay. For this one, I think we should skip. Would you like to study the sterilization or unsterilization? But I think for this topic, I can leave it, and I will not include it in the exam. But I would like to explain. Let's see. Okay, I will draw your attention to this one. For the sterilized, let's see this one first. For the sterilized and unsterilized FX intervention, it will not be in your final exam, okay? Because this one, why I don't include it into the final exam. Because this one would be better if we study the ISLM diagram. Have you ever heard about the ISLM? Okay. ISLM and BOP. Because it will give you the pictures of when the central bank try to make the monetary policy effective. Okay. But anyways, I would like you guys to familiar with the term. It would be sufficient. But let's take a look at this one. This is the Impossible Trinity. Okay, the Impossible Trinity. That is, these cannot be occur at the same time. These cannot be occur at the same time. That is the country that embrace the fixed exchange rate at the same time as the independent monetary policy, at the same time as the perfect capital mobility. Why? Okay, let's think about it in terms of the logic rather than using the graph. Suppose that you increase the money supply, the interest rate or the short-term interest rate will go down. That is, your domestic interest rate will go down compared with the foreign interest rate. Okay, what will happen next? If you have the perfect capital mobility, capital inflow. As a result of this, the domestic currency will appreciate against the foreign currency. Can we have the fixed exchange rate? If you still would like to embrace the fixed exchange rate, the central bank need to do the sterilized FX intervention. But this one is very temporary. It is not contemporary because it depends upon the amount of the reserve in the pocket of in the wallet of the central bank. Okay, the central bank may have to use the foreign exchange reserve to intervene the FX market in order to make the exchange rate fixed. In Thailand, before 1997, we adopt the fixed exchange rate regime. But in July, if I'm not mistaken, in July 1997, the central bank cannot intervene the FX market anymore. We ran out of the foreign asset. Okay, foreign asset. I mean the foreign exchange, the foreign reserve. Okay, we ran out of the foreign reserve. So that's why we cannot intervene the market anymore. That's why we have to float. Let the exchange rate float. Okay, let the exchange rate float. So you can see that for this one we have 25 baht per $1, and this one we have 50 baht, 50 baht to 60, nearly 54, but this guy is 50. Let be sure. I think it is 50. So you will see that we have 25 jump to 50. This is the structural rate. This is the structural rate because the central bank cannot intervene in every market anymore and let the exchange rate float to the demand and supply. Okay, so for this one we have what we call the flexible exchange rate regime. Okay, the flexible exchange rate regime. We let the demand and supply determine the exchange rate. In fact, we still have the central banks also intervene the market, but the degrees of the intervention is very little compared with the period before the 1997. So this one we let the demand and supply determine the exchange rate. Okay, that is all about the topic that I would like to give you today. And the next topic is the financial crisis. For this one, I will not teach you directly, but I will let your friend teach you with that presentation. And remember that the topics that your friends present to you, it can be in your final exam too. So listen to them carefully. And okay, for this one, I will leave the topic, and you can read it if you like. And if you have any question, you can ask me about the slide. So see you at 1 p.m. Okay, 1 p.m. or 1:30. 1 p.m. Raise your hand. Or 1:30. 1:30, right? I have two choices. 1 p.m. or 1:30. 1 p.m. Okay, 1 p.m. Okay, 1 p.m. Okay, see you in this room. Thank you very much for your attention. Okay, see you.